In this session, I'm going to look at the basic introduction to the income statement. We all know that the income statement typically contains the revenues as well as expenses. So, a list of revenues, a list of expenses subtracted to typically finally provide the net income. So, this is what is a broad composition of the income statement, and this information is collected over a period of time. So probably it is like all the revenues that happened during the current financial year, all the revenues during the current financial year, all the expenses during the current financial year, and the net income during this financial year. So it could be on an annual basis, or it could be on a quarterly basis depending on the requirement. The income statement is typically prepared. So over a period of time, whatever are the revenues and the expenses, those are typically taken care of as a part of the income statement. So that's the reason in some cases the income statement is also called as profit and loss statement, because the net income is nothing but the net profit or net loss that is going to come up after subtracting the expenses from the revenues. So otherwise also called as statement of earnings. What is that the company has finally earned? So that's the reason even we call it as statement of earnings, more commonly called as a profit and loss statement. So this is on a broader scale what an income statement is, but here comes the presentation or the reporting mechanisms wise, right? From a reporting perspective, here I have to look at IFRS, International Financial Reporting Standards. As per the IFRS, the income statement plus other comprehensive income, these two can be combined together and called as the statement of comprehensive income. Either they can be combined and created like this, or the income statement can be presented separately, other comprehensive income can be presented separately. So either of these presentation formats is very much acceptable. But yes, I need to know which format the company is typically presenting. Even a few other accounting standards like US GAAP also go with this kind of presentation mechanisms itself. And why do someone use this income statement? Who all can use it and for what purpose? As we know, the financial statements which are prepared by the company are majorly used by various stakeholders, and primarily they can be used by investors, or they can be used by some creditors, or they can be used by lenders, any different kinds of parties. There could be many other parties who could be using them. Probably the investors are more interested in valuation of the particular firm, so they will evaluate the profits, the losses over various years to finally arrive at the valuation of the firm. And probably from a lender's standpoint, their understanding of the income statement is to assess the company's ability to repay, ability to pay interest on time, ability to do a principal repayment whenever required. So the lenders would evaluate the income statement of the company from that purpose. Creditors would typically look at from the purpose of again the company's paying capacity. So is the company sufficient enough to pay back pay back for the raw materials or for any other credits the company has taken during the short term. So all these things are typically going as a part of the income statement. Now just trying to understand a little bit more in detail. Now as we know that income statement typically contains only revenues, expenses on a broader category, right? Revenues and expenses. So whatever something came from the sale of goods and services, whatever the amounts the company has obtained from the sale of goods and services which are as a part of normal operations of the business. So for an automobile company, the sale of cars, whatever is the amount that is obtained because of the sale of the cars, typically goes as a part of the revenues. But in some cases, these revenues can be adjusted. To the revenues, there could be some kind of adjustment that could be done, especially with expected returns because of warranty, because of defect. There could be some expected returns. Means if I have sold some 1,000 cars, I am expecting 1% of them, which is 10 cars, can typically come back. Which means my revenue will not be for 1,000 cars which I have sold. I am adjusting it with 1%, which is an estimate that I am making. Adjusting it at 1% of the vehicles that can typically come back, and finally reporting the net revenue. Instead of showing the gross revenue, generally I can show a net revenue which is adjusted based on the expected returns of the goods and services that I am selling. So on a broader scale, that is what consists of the revenue. Now when I look at the expenses, it is the cost that is typically incurred to generate the revenue. Whatever the company has incurred as a cost to generate this particular revenue. It could be cost of manufacturing that particular product, it could be cost of selling it, whatever the company has incurred as a cost during this process to generate this revenue, all of them get treated under the expenses. Broader cost of goods sold, direct costs that are associated with the goods that got sold, any other operating expenses that are there, administration, selling, marketing, all these things, any financial expenses that are there which are more associated with interest payments on the loans taken, and any other taxes, all these things go as a part of the various expenses. And all these expenses in the income statement, they can be grouped either by the nature. So there could be again something like depreciation. Now depreciation is a grouped by nature kind of grouping, because depreciation of plant, depreciation of machinery, depreciation of buildings, all of them are typically grouped into one single element on the income statement called depreciation. Or in some cases, it could be function wise grouping. When I say function wise, if I look at the finance expenses, all the various loans that have been taken in different forms, the interest that needs to be paid on all the loans is grouped together as a part of finance expense. Probably I call it as interest, but the interest for various expenses, or probably when I look at cost of goods sold, it's a cost that is incurred with respect to manufacturing that particular product. So in some cases it is purely based on function, the grouping. In some cases it is purely based on the nature, but some of the things which are directly expected to be present as a part of the income statement going to all these things. And from a presentation standpoint, it is expected that in a particular income statement, if I am preparing it, let's say for the financial year ending 2014, I need to even present the same data one for financial year ending 2013 as well. Now, these two, so whatever are the content, let's say the revenues, again different subheadings under the revenues, expenses, different subheadings under the expenses, and finally the net income. I have to present it for 2014 as well as 2013. But with respect to the presentation, either this way is also okay, where the latest is first and the earliest is next, or even this kind of a presentation is also okay. First the earliest year and then the latest year can very well be coming up. And from a few formats perspectives also, sometimes for expenses people generally show them as negative numbers, or sometimes people put them in parentheses. Any of these presentations are quite comfortable as long as expenses are subtracted from the revenues to typically come out to the income. Apart from revenues and expenses, we also see something relating to gains and losses also in the financial statements. So whenever I am seeing some kind of increase in benefit, right, when I am looking at some kind of increase in the benefit, either because of normal business operations, or non-normal business operations, whatever is the increase in the benefit that is coming up, that can be treated as a gain. Especially like, okay, I have sold off a machine. I have sold off the machine. Now there is a book value associated with the machine that is shown in the financial statement. I would have sold the machine in reality at the selling price. Now what we see is, we'll try to find out the selling price minus the book value. If it is positive, I'll treat it as a gain. If it is negative, I'll treat it as a loss. So this is a gain that is coming because of selling a particular asset. The same way, this is as a part of the normal business operation itself, because the machine which I have been using for running my business. Whereas when I look at some investment, I have bought the shares of some company, may or may not be from the perspective of doing a business, just for exploiting the pricing mismatch. So let's say I have bought the shares of some company, and now I am selling off the shares. So whatever the profit that I have got, that is a gain, but not from normal business operations. So all these gains, if it is from normal business operations, it could be treated as a part of operating income, operating gains. If it is from non-normal, I can very well treat it as completely non-operating kind of gain. But all these gains are represented as a part of the income statement. Similarly, if these kind of things have resulted in a loss, they are represented as a part of losses, which means when I have to arrive at the net income finally, it is like I look at revenues minus whatever are the operating specific expenses, which are normal business related operations, any other income that I have got minus other expenses. So these are more operating specific expenses, which are core business operation specific, non-operating income, non-operating expenses, and any kind of gains minus losses. All these things put together is going to create my net income. Apart from that, we also see a few additional elements coming to minority interest in the income statement. I also see one more heading typically called as minority interest. Sometimes it's also called as non-controlling interest, especially if a particular firm has acquired another firm. Let's say A has acquired B, but not 100% of B. Let's say 80% of B has been acquired. Now, what the accounting rules simply say is the entire revenues and expenses of B will be clubbed into the income statement of A. Though A owns only 80% of B, the entire 100% of the revenues and expenses of B will be clubbed into the income statement of A. So which means even the profit wise 100% is clubbed into the income statement of A. But A actually owns only 80% of it, which means the remaining 20% of B, which is not owned by A, is typically called as the minority interest. The 20% of the profits of B for that particular year, which does not belong to A, is what we call as the minority interest. So what we do is, whatever is the final net income that comes by when I prepare the income statement by taking 100% of the revenues and expenses of B into A, whatever the net income that comes, from this net income, there is a subtraction of the minority interest of B. And finally, the overall final net income is going to come up. So this is one more element that could be present, especially if a company is having some kind of subsidiaries where the stake of the company is not 100%, is less than 100% stake. We will see that this kind of additional element for minority interest is also being present in the income statement. Then, coming to the various presentation mechanisms of this financial statements, we can talk about either a single step presentation wherein we just group all the revenues minus all the expenses and directly we come out to the net income. A simple presentation in one single step. Or we are coming out with a multi-step kind of a process where a bit of more detail out is happening. So here we first look at revenues. Instead of taking all the expenses, we take only cost of goods sold first. The difference will give me the gross profit. And from the gross profit, we deduct, let's say, selling, general, administrative, all operating related expenses. And and even the depreciation, because depreciation is also related to the operations, where we can finally arrive at operating profit or operating income. Then from this, the interest part is subtracted to arrive at income before tax. Then tax part is subtracted to typically come out with income, net income, or income from continuing operations. Then any discontinued, whatever the profit or loss on discontinued operations, and even the minority interest, if at all there is existing, that would be subtracted to typically arrive at the final net income. So this is a more detailed way of presentation of the income statement, which is generally followed by many organizations, a general presentation of the income statement wherein we denote the gross profit, which is majorly relating to the production cost or service costs, which are directly producing the revenue. So all those things are subtracted to arrive at the gross profit. Then I'm subtracting the operating costs. These two are operating because marketing costs, selling costs, administrative costs, depreciation, all these form the operating costs, resulting in operating income. And then we are looking at financing, income tax, then minority interest, all these things subtracted to typically arrive at the net income. Sometimes in some languages the net income is also called as profit after tax, or in some cases it is used as earnings, and in some cases it's even used as bottom line. While the gross profit is typically called as your top line, which is more associated with the revenues, whereas the net income, which is more associated with the bottom line. So a basic understanding of the income statement of this form is very much necessary to typically evaluate any firm's income statement, right? In this session, I'm going to look at the mechanisms of revenue recognition in the financial statements. So as a part of this session, I would be focusing more on the general principles associated with the revenue recognition. What are the general rules, right? And I would also focus on any special cases, some special cases under which there is a difference in the way the revenue is recognized, especially how would I go about with long-term contracts, right? How are the general principles slightly deviated when I have to consider the long-term contract, or when I have to consider the installment sales? What is the difference that comes into the revenue recognition mechanism? Or in case of barter transactions, how would the revenue recognition change? And how would we differentiate between a gross reporting versus a net revenue reporting? So some special cases of this kind we would consider. And finally, from a financial analysis standpoint, what is that a typical analyst need to consider, and what are the various implications that are associated with respect to revenue recognition? So these are some of the things that we take up in this particular session. So starting off, we know that majority of the times the revenue is recognized in the financial statements based on the accrual method, right? All the financial statements to a large extent have a basic assumption of the accrual method itself. And just to highlight, in the accrual method, we said that revenue will be typically recognized when we have earned it, right? And similarly, the expenses would be recognized when we have really incurred them. So first focusing on the revenue side, when we have typically earned, but nothing to do with the timing of the cash receipt. Time of cash receipt has nothing to do with the revenue recognition. Similarly, cash payment time has nothing to do with expenses recognition. So at least that much we need to be comfortable with. So in some cases there is a possibility of earlier recognition, and in some cases later at a later point compared to the moment of cash. So this typically happens. Now, as far as the general rules general rules for revenue recognition are concerned, when do we typically recognize the revenue? As per IFRS, there are a few criteria that needs to be met. Risk and reward of ownership. So the ownership is typically transferred from the organization to some other party. So which means whatever has, let's say a car manufacturing company, it has sold the car to the other party. So the risk and reward of anything that is going to happen to this particular car, if it is now the responsibility of the person who has purchased it and not the company, then this company can very well recognize that amount as a revenue. And whatever the good that is sold, no control. Now, if I lose the control or the management of this particular good, then I can very well recognize it as a revenue. And there should be a reliability in measurement. The value of it, how much I may be getting out of it, irrespective of whether I get the amount today or later, I should be able to measure the value of it reliably. Even the cost that is associated with this particular good that is sold, I should be able to measure the cost associated with it reliably, and there should be a good probability that I would be receiving the money. It should not result in a default. To a large extent, I should be confident that I would be getting this money. If I have got it already, fair enough. Even if I am going to get it in future, I should have some kind of confidence that I would be getting the money out of it. The same logic goes even with any kind of service that I am rendering. So I should be able to measure the value that is associated with that particular service. I should be very much sure that I would be getting the money for the service that I have performed, and to what extent the completion of that particular service. How do I define the completion of that particular service? I should have a mechanism for it, and whatever is the cost that is incurred in terms of rendering that service, I should be able to measure that cost, right? Whereas even when I am looking at US GAAP from the recognition perspective, it says that, okay, from the buyer and seller, there should be some kind of an agreement that the buyer will be paying money and seller would be delivering the goods, some kind of agreement, and the evidence of that is there. And the product is actually delivered from the seller to the buyer, or the service is performed from the seller to the buyer. Whatever is the price for this, it is already determined, or there is a formula to determine it. So it is either determinable comfortably, or it is already determined. So even in that case, and this company, the seller is almost sure that the buyer would be paying the cash for it, if not now, at a future date. So the gap says not just earned, even if it is realized, or even if it is realizable. If I am very much sure that I am going to get to a large extent, I can very well recognize it as a part of the revenue. But whatever it is, to a large extent, both of them try to come out with similar set of rules as far as the revenue recognition is concerned. But in case there is an advanced receipt of cash before the service is actually rendered or good is actually delivered, then whatever is the revenue that is not for the current period, that would be for the future period, which means right now it goes as a part of unearned revenue, which goes as a part of the liability. So when the real service is delivered, so here right now, as per the accounting transaction, the cash, which is an asset, is going to go up, and unearned revenue, which is a part of the liability, is going to go up by that extent. Whereas at a later point, when the service is performed, the revenue is increased. So revenue increase is resulting in net income increase, which is resulting in the retained earnings increase. So the owner's equity part is typically going up, and on the other side the unearned revenues is going down. So the adjustment is happening that way using this double accounting kind of a mechanism. So in general, this is how we recognize the revenue. But what happens is, not all in not all cases this procedure is applicable, right? Most of the times we try to recognize the revenue at the point of delivery itself. But in some cases, which I call them as special cases, there is a possibility of recognizing the revenue before the delivery happens, much before the delivery, or I will recognize the revenue much after the delivery. But in most of the cases, regular cases, we talk about recognizing the revenue at the time of delivery only. But in special cases, it might very well be possible that the revenue is recognized either before delivery or after delivery. And of those kind of special cases, typically I look at as one, the long-term contracts, contracts which go for more than one financial year. Generally, with construction contracts, we observe this kind of behavior because they go for much longer period of time. Then we look at the installment sales, when the company has more or less promoted selling a particular good or service on an installment payment basis. And if there are barters, how would I typically treat? And when do I go with the gross versus the net reporting? These are some of the special cases that I am more interested in seeing. Now, from that perspective, we'll start off with the long-term contracts, right? We'll start off with the long-term contracts, especially those contracts whose period is for more than 1 year. Here, there are two major mechanisms that come into picture. One is percentage of completion method, and two, we look at completed contract method. These are the two kinds of methods that are applicable for recognizing the revenues, right? Especially when we talk about construction projects which are long term, or where there are long term licensing and service agreements. Long term service agreements or long term licensing agreements that are typically done. Even in that case, the revenues are recognized either uniformly over the period or based on the percentage completion or the completed contract. So looking at percentage completion, especially when we talk about the project being reliably estimated. So which means the outcome, I can very reliably estimate the outcome. I'm doing the same routine task which may go for 3 years, but I can estimate that my outcome will be completed in 3 years time span. Probably I can say that the first year 50% of it will be done, the second year 40% of it will be done, and third year 10% of it will be done. Some kind of reasonably reliable estimation I can do about the outcome of the project. Then I will rely on percentage completion kind of a mechanism. So in that case, okay, if I say this is what it is, let's say I'm talking about $100 million project, $100 million project, which I am estimating 3 years to complete it, right? I am incurring a total cost of, let's say, $75 million is the cost that is incurred, out of which, let's say, around 37.5 million is incurred in the first year, then around 30 million is in the second year, and 7.5 million is in the third year. Now what we say is, as per the percentage of completion basis, we look at what is the percentage of work completed. Percentage of work completed is purely based on the cost. Okay, total cost is 75 million. We are incurring these costs in each of the years. So what typically comes out is 50%, 37.5 out of 75. 50% of the work is completed in the first year, 40% in the second, and 10% in the third. So the way we recognize the revenues, expenses, and profits are primarily like this. So because I'm expecting that I'll get 100 millions for this particular project, the revenue. So what I'll recognize is 50% of the revenue, 50 million will be in the first year. Then similarly 40% would be recognized in the second year, and 10 million would be recognized in the third year. Expenses also 37.5 million in the first year, 30 million in the second, and 7.5 million in the third, resulting in a profit of 12.5 million in the first, 10 million in the second, and 2.5 million in the third. So this is a way the percentage completion contract method works, right? So the revenue, the expenses, and the profit, they are recognized based on the percentage of the work that is completed. And the percentage of the work that is completed is purely based on the cost associated, cost that is incurred in each of the periods as a proportion of the total cost. So this is supported both in US GAAP as well as under IFRS. So whenever the reliable estimation of the work can be done, we can very well use this percentage completed contract method. Whereas if the reliable outcome cannot be reliably measured, outcome is unreliable either in terms of the duration of completion, or the real completion of the work itself. If it is completely uncertain, there is a difference between the IFRS and the US GAAP. What the IFRS simply says is, the revenues and expenses, treat them to the extent of cost. Treat them to the extent of cost. So in the same example earlier, where we talked about 37.5 being the cost in the first year, 30 in the second, and 7.5 in the third, and a revenue of 100, what this mechanism simply says is, you treat 37.5 million in the first year as revenue, even the expense is that much, which means the profit is zero. In the second year, you recognize 30 million, 30 million, and a zero. Now this is where, if you are completing the contract in this particular year, the entire remaining revenue, whatever you got, 32.5 million, you recognize in this particular year. Expense is only 7.5 million, resulting in a profit of 25 fully in this particular year only. So especially if the outcome is not reliable, outcome can't be measured comfortably. Now what we are saying is, revenue I am recognizing to the extent of costs. Revenue I am recognizing to the extent of costs, and the profit is recognized only on the completion of the project. But the same thing under the US GAAP, which is called as completed contract method, a slightly different version. Under a completed contract method, what happens is I don't recognize any revenue, any expense in the years until the contract is completed. Only in the final year, the revenue as well as expenses, both of them are treated, and the final profit is computed. So I won't have any kind of revenues and expenses until the project is completed. Only on the final stage I'm going to showcase both my revenues as well as expenses. So what we see is this approach is more and more conservative, right? Whether it is this approach or this approach, the completed contract kind of a method is more and more conservative because the profits are recognized at a much later point in time. Whereas under the percentage completion method, the profits are recognized much earlier. In the first year itself, we showed revenues as 50, expenses as 37.5, resulting in $12.5 million profit. So, though the overall profit is still 25, here we are saying that the 25 will be recognized only in the last year, whereas in the percentage completion method, I can recognize the revenues much earlier also. I can recognize the revenues much earlier also, which means this kind of percentage completion method is more and more aggressive, and in this case it's even more subjective as well, not just aggressive, it's even subjective. Now whatever is the cost estimate that I have done, under the assumption that my actual cost would meet this cost estimate, if I had done this cost estimation slightly on an aggressive basis, lessening the costs, and actually I had incurred more costs, I could typically see that the percentage completion says a very high percentage is completed, which could result in revenues being recognized much more, profit being recognized much more. So what is the basis for estimation of the cost and how accurate are the cost estimate? One more important dimension in terms of the assessment of the recognition. So it's more subjective, but on the positive side, I see that my profits are generally smoothened out, right? Rather than seeing 0 and suddenly 25, which is completely irregular, I could see at 12.5, 10 and 2.5. The standard deviation or the variance of the profits is much lesser here, whereas the variance of the profits is much higher in this kind of a mechanism. So that is one more area which needs to be evaluated. But overall, we could, and probably this looks like a better matching also, because I got some kind of expenses and I got some kind of revenues. So some work has been performed in each of the years. So better recognizing the revenues and the expenses, more or less a good matching with the revenues and expenses is possible through this method. But when I look at the real cash flows wise, no issues. Both of them will show the same because it's a real movement of cash, nothing to do with the accounting standards or accounting rules, right? So as far as the long-term contracts are concerned, either we can go with a percentage of completion method or we can choose to opt for the completed contract method also. Then the next important special case that I would like to look at is the installment sales mechanism. So in a lot of cases, the company has sold a good, but it has given an allowance to the customer to make the payment in 3 or 4 installments. The amount that the customer need to pay in each of them is typically known in advance, is decided at the time of purchase itself. So the sale is done here, the company is like it has financed the sale. it has given a loan and it is asking the customer to pay in a few installments. So the payments are expected to come only at these points in time in the future. Here again, there could be scenarios where the collectibility, now again that comes out, how comfortable is my collectibility? Is it fully certain? Am I fully sure about the collection or somewhat uncertain? I'm somewhat uncertain and probably highly uncertain. I'm looking at three mechanisms: somewhat uncertain, highly uncertain, and certain. When I'm more or less certain, what it typically says here, this is again the situation where I look at US GAAP versus IFRS. Under the US GAAP, if it is more and more certain, so I'll use the normal method itself. At the time of delivery, I will recognize the complete revenue. But if it is somewhat uncertain, this is where I'll use a method called installment sales. And what is that I do in the installment sales method? The profit, I will start recognizing the profit as the cash is collected. I will link the profit recognition with the cash collection. So let's say I have sold, again the same example I'll take. I've sold something for 100 million. The cost that I have incurred on it is 75 million. Right? And let's say I have sold it for 100 million and I have gone into an installment scheme where 50% has to be paid in the first year, 40% in the second year, and 10% in the third year. So which means the customer will pay 50 million, will have to pay 50 million in the first year, 40 million in the second, and 10 million in the third. If I assume that he has paid that way only. So what I'll do is in the revenues, in the first, second, and third years, I'll recognize 50 million, whatever I have received, not what I should receive. Whatever I have received, I'll put 50 million in the first year. Then I'll go with 40 million in the second and 10 million in the third. Expenses also, I'll take it in that proportion only. So 37.5 million in the first, 10 million in the second, and 30 million in the second and 7.5 million in the third, resulting in profits recognized to the extent of cash that is typically collected. So this is typically called as the installment sale. So when in this case, I am recognizing the profit based on the cash that is collected during the period. Right, so to whatever extent I have collected the cash out of the expected, out of the amount that I need to receive, that proportion I'll assign it to the expenses also, and from there I'm going to collect the cash. So that is the installment sales method. Whereas when the collectibility is highly uncertain, I'll use a cost recovery method. Until my full cost is recovered or realized, I will not show my profit. Assuming the same example that he has paid 50 million in the first year, 40 in the second, and 10 in the third. In this case, what I'll say is, okay, I'll not recognize the profit until I got my whole cash back, which means first year if I have received 50, expense also I'll put as 50 and show profit of 0. In the second year if I have received 40, cost wise only 25 is still to be left. So I'll recognize 25 more. My cost is completely recovered. So I'll recognize a profit of 15 here. And in the third, where my revenue is going to be 10, I'm going to receive cash of 10. Now there is no more cost that is involved. So I'll recognize a profit of 10 here. So in this case, my profits go through this until I recognize my whole cost, until I collect my whole cost. I am not going to recognize the profit. So only when the cash collected is increasing the cost of selling that, then only I am going ahead with recognizing of the profit, right? So this is what is a cost recovery method. Now, small change. In case of IFRS, see, these are all the things under the US GAAP. But in case of IFRS, especially the installment sales method, what is typically done is the present value of all the future cash flows. Present value of the future installment payments is computed and is recognized at the beginning itself. Right? At the beginning, I find out the present value of the future cash flows, not the exact future cash flows. I'll take the present value of the future cash flows at the beginning. And so, which means if 50, 40, and 10 have to come out, probably a present value of these three, let's say it's around 88 million. Now, what I would be doing is 88 million is what I would be recognizing as a part of the revenue for the current year, right? Only 88, not 100. And whatever is the remaining 12 over each of these periods, depending on how much has to be paid, that difference would be recognized in the form of interest. It would be recognized in the form of interest over the year 1, year 2, and year 3. So that's a key difference that is existing between the IFRS and US GAAP with respect to handling of the installment sales. But where there is a kind of high uncertainty with respect to the collectability, then again a cost recovery method only is going even under the IFRS also. A US GAAP and IFRS, they don't differ with respect to cost recovery method, where there is a lot of uncertainty with respect to the collections. But installment sales, a small difference, instead of recognizing or even when there is a certainty in terms of collection, instead of recognizing the whole sale in the current year itself, the present value of the future expected installment payments is what is recognized in the current year as the revenues, right? So these are some of the important aspects with respect to the installment sale. Then the next important piece that we need to look at is the barter. Majority of the times in a barter, what happens is A is giving some goods to B, B is giving more or less an equal valued goods to A. No cash payment, right? So this is a typical barter transaction. So there could be a round trip, a transaction as well. In case of round trip, A has sold a good to B and almost simultaneously purchased similar kind of products from B. Typically, let's say the online advertising space. A has sold space on its website to B. B has sold a space on its website to A. Both of them have typically sold some kind of spaces on their respective website, and both of them had made revenues. So these kind of transactions are typically called as round trip transactions. Now, first of all, what I need to understand is the revenue which we have got because of the sales of these things. Revenue, how it should be recognized. In these kind where there is really no payment, how should a revenue be recognized? Now, in this case, the US GAAP as well as IFRS, what they are typically are saying is, the US GAAP says revenue, look at it as a fair value. especially if there is a historical record. Means in the past, if this company has sold similar kind of a good or service for cash, and that experience can typically be used to compute the fair value, then you can recognize it under the US GAAP. But otherwise, if you are not able to assess your historical transactions where you have sold this good or service at cash earlier, then it talks about treat your revenue to the extent of the assets that you have surrendered. Means whatever the goods that you have purchased, whatever is the value that is associated with the carrying value of the asset that is typically surrendered. So these are the assets that you have sold, A has sold to B. Whatever is the book value of them, treat that to be the revenue. Whatever is the book value, treat it as a revenue. Whereas in IFRS, we see again on a similar lines, whatever is the fair value of similar non-barter transactions, if at all they are existing in the marketplace, whatever is the fair value that is associated with the similar non-barter transactions with unrelated parties, whatever is the revenue that is received in that particular transaction, that could be treated as revenue under IFRS, right? Then revenue reporting itself, there are two major aspects here. There is a form called gross revenue reporting and there is a net revenue reporting. Which one I should look at? When I look at gross, the way it is reported is like this. We talk about sales, cost of goods sold, and then we call it as the gross profit. Whereas in the net, I don't show sales minus cost of goods sold, we directly call it as net sales, which is again the sales minus the cost of goods sold itself. So in net sales, and from there we go ahead with the operating expenses and all that stuff. Right from here it's the same, but the only the revenue reporting, will I be reporting in this format, which is typically containing the gross revenue? If I am subtracting both the revenues minus the expenses and arriving at net sales and representing it, we call it as a net revenue reporting. Generally, we see that a lot of intermediaries which would be reporting the net reporting mechanism, but someone who is the primary producer of the product, who is typically bearing the inventory risk, who is typically bearing the credit risk, who has a reasonable control over the price of the product, these kind of companies, they have to go with the gross revenue reporting. Whereas any intermediaries who do not have much of a hold with respect to the price, or who do not control the inventory, who do not have a control on the credit risk, these kind of intermediaries, it's better that they do the reporting on the net. So all financial intermediaries, all dealers who receive brokerage or commission for selling the products, it's better that they report on a net reporting basis rather than a gross, because they don't have any kind of a hold in terms of the price of the product, right? So these are some of the important aspects, some special revenue recognition mechanisms that we need to be aware of. And coming to the perspective of financial analysis, to what extent I should look at the income statement from a financial analysis perspective. We have seen now there are instances where the revenue recognition is happening at delivery, before delivery, or even after delivery. So there are instances where Revenue recognition is happening at different points in time, and so which means the revenue recognition methods are different for different kinds of transactions. One single firm itself can use different methods of revenue recognition. So what kind of methods for what kind of revenues they have typically applied should be seen as a part of their disclosures in the footnotes to the financial statement. So from an analyst standpoint, reading through the footnotes regarding the revenue recognition procedures need to be very much focused on, and that clearly gives some kind of an estimate whether the revenue recognition mechanism of the company is more and more aggressive or conservative. When it is aggressive, then probably it focuses more and more on percentage completion method, or it focuses more and more on normal revenue recognition method, even if it has done an installment sale. But if it is more and more conservative, we see that it could use a cost recovery method or a completed contract kind of a method. So it gives a picture about whether the revenue recognition policy of the company is more aggressive or conservative, and to what extent the company is using its judgments and estimates in terms of what is the kind of reliability and accuracy associated with the judgments and estimates with respect to the revenue recognition or the cost of the projects, right? So these kind of things typically need to be kept in mind when we are focusing on the revenue recognition mechanisms. All right. In this session, I'm going to primarily look at the expense recognition, and primarily I would focus on the general principles associated with expense recognition for different kinds of expenses. So we'll look at what are the principles that are associated for inventory related expenses recognition. What is it we will look at with respect to depreciation? What are the general principles associated with depreciation expense? Or what are the general principles that are associated with amortization expense? And I can also focus on something to do with the warranties, bad debts, different kinds of expenses. What are the general principles that are driving them? And once we are any special cases that are there with respect to these different kinds of uh, expenses, even we would be looking at them. And how should, again, a financial analyst, how should he look at the expense recognition mechanisms of the company to play a role in terms of analyzing the financial health as well as the performance of the company. So again, just a quick repetition, we know that expenses have to be recognized based on the accrual method only. When I'm saying accrual method, we will be recognizing the expenses as they are incurred, not based on the cash payments that are typically being made, right? And so generally revenues minus expenses is what will give me the net income. So because of this accrual basis, the different expenses, I need to understand on what basis I am recognizing them, and majorly the discussion happens with what is called as the matching principle. What this matching principle simply says is, whatever are the expenses that we are incurring to generate the revenue of the current period. So whatever the expenses that were incurred to generate the revenue of the current period, only those will be treated as expenses, which means if I have purchased a good in Q1, but this good Q1 got into production and probably got sold in Q3. Then Q1, whatever is the purchase price, because it's a revenue in Q3, the purchase of this particular item, the expense for this will be shown in Q3 only, not in Q1, which means in Q1 it is still an inventory. It is not going as a part of the expense, it is still lying in the balance sheet as the inventory. So that is where we say whatever the expense that is incurred to generate the revenue is recognized as an expense in the same period as the revenue. So in whichever period the revenue is recognized, the expense to generate that revenue is treated as an expense in that particular period itself. So this is one major principle that drives the expense recognition. But sometimes what happens is not all expenses can be directly tied with the revenues. There could be some expenses which are more and more periodic, which are more routine in nature. Salaries, the salaries of the employees, they may or may not be directly tied up to the revenues. They are not directly used to generate the revenues. Even if the revenues are lesser, there could be an expense that could be incurred, which means those kind of periodic expenses, even the rent, may not be directly tied up with the revenues. It's a periodic kind of an expense. So in those kind of cases, whichever the expenses can be directly tied to the generation of the revenues, will apply the matching principle. Whereas in case of periodic expenses, it's better that we recognize them as expense in the period that is incurred itself rather than trying to use the matching principle. So in general, the clear understanding with respect to when to use the matching principle and when to use the periodic expenses need to be understood in a much better manner, right? Now let's go into the specifics. Cost of goods sold, one of the major expenses, one of the major expenses in the income statement, the cost of goods sold. Otherwise, I look at it from the perspective of the inventory based expense. Here, there are four major kinds of expensing mechanisms that are discussed. One is called as a specific identification method. Then we talk about first in, first out, FIFO, last in, first out, LIFO, and then we call weighted average cost method. So these are the four ways in which the cost of goods sold expense is identified and recognized into the income statement. The simple logic is whatever the raw material is, if I can specifically identify a raw material, right, and this particular raw material has gone into this particular good development and this particular good got sold. So whatever is the expense that is exactly associated with this particular raw material is denoted as cost of goods sold. So especially where the one-on-one identification, especially for very premier products, premier raw materials, we could see that there is a one-on-one identification. Okay, raw material with number AXP2 has actually gone into the production of this particular product. This got sold. So which means the cost that is involved exactly with this AXP2 will go as cost of goods sold. So there is an identification number. So the cost of goods sold will simply contain the individual costs associated with the specifically identified kind of raw material cost. Whereas in some cases what could happen is all the raw materials are identical, right? All these goods they have been purchased at different points in time and they have gone into the production. In general, what happens, the one that is earliest purchased, if there is no specific identification to any one of them, it could very much happen that the one that is procured early, the earliest, that goes into the production first, and those goods get sold first. So whatever the goods that are sold, the expenses that are associated with those goods that are sold, I will take the earliest of the purchases as cost of goods sold. So the cost of goods sold will contain the earliest purchases and the latest purchases will go as a part of the inventory in the balance sheet. Now just to demonstrate it with an example, let's say in Q1 I have purchased 10 materials at 10 bucks. In Q2 I have purchased 20 materials at 20 bucks per material. In Q3 let's say I have purchased 30 materials at 30 bucks. Whereas in Q4 there is a sales that has happened of 40 materials at 40 bucks. Let's say this is what are the transactions that have typically happened. Now, if I can identify what are the 40 that are sold and which out of these 60 raw materials have gone into the production of this 40, probably 5 units of this, 20 units of this and 15 units of this that have gone for the 40. Then if that's the case, I'll take the cost of this 40 and directly show as cost of goods sold. That's a specific identification. Whereas on the other side, if I am using FIFO, okay, I have sold 40 at 40 bucks. So my revenues will show at the end of Q4, my revenues will show 1600. My cost of goods sold here is corresponding to this 40 units that I have sold. I will take the 40 units, the earliest ones, okay, the first 10, the next 20, which is 30, and 10 from here. So that makes up the 40. So 10 at 10, 100 bucks, 20 at 20, 400, and 10 at 30, 300. So overall my cost of goods sold is becoming 800. So my gross profit is coming out to 800 here, and my inventory in the balance sheet will contain the remaining 20. So here it is the remaining 20 at 30 bucks. So my inventory is showing around 600. So this is what happens as a part of the FIFO. The earliest purchases are going as a part of cost of goods sold, and the latest purchases are going as a part of the inventory. So the main assumption is the first item that is purchased is going into the first item that is getting sold. So that's a major assumption that is going in. So the most recent purchased item is typically going into the ending inventory calculation. Typically more and more appropriate where there is a perishability that is associated with the products. Obviously the first earliest purchased ones I want to use up first. The latest purchased ones, they look more and more fresh, so they can be used even at a later date. So for those kind of firms, probably without any doubt, the FIFO based inventory valuation is much more appropriate. But when I look at the other one, the LIFO, the last purchased goods are the ones that are considered as first sold. right? The last purchased ones are treated as first sold. So applying the same to our example here, the revenue is still 1600 bucks, but the cost of goods sold in this case, okay, I've sold 40 items, so I'll take the cost also associated with 40. So 30 I'll take from the latest purchase and 10 I'll take from the previous. So 30 at 330, 900, 10 at 20, 200. So overall the cost of goods sold is 1100, resulting in a gross profit of 500, and even in the inventory I'll consider 10 at 20 and 10 at 10. The oldest ones are being treated as a part of inventory. So my inventory is showing 300 bucks in this case, right? So the last items whatever I have purchased, they are treated as expense associated with the first item that is sold. So all the recent purchases are going as a part of cost of goods sold, and the earliest purchases and the previous period inventory is taken into the ending inventory. So especially for those kind of products where there is no deterioration at all and which are typically piled up. So anytime a purchase is happened, it is typically piled up, stacked. So what generally happens, whatever is at the top that goes into the production earliest. So this is an old purchase, but it comes again into the production at a very later point in time. So LIFO is more and more appropriate for those kind of firms. And on the other side, I could typically see LIFO as a mechanism for getting tax benefits. Why so? In general, we see that the costs keep increasing, inflationary kind of an environment. So because of the inflationary environment, the costs are typically expected to grow over time. So more and more costs going up, the latest purchased ones will be more expensive compared to the earliest purchased one. So obviously the cost of goods sold, especially when the prices are increasing, I see that the cost of goods sold is much higher compared to the usage of FIFO. So cost of goods sold higher, the gross profit reduces, even the whole chain goes like that. The net profit also reduces, the net income is reducing, means the taxes are also getting reduced. So the tax, it can be used as a mechanism to save tax, especially in kind of inflationary environment. That's one more way which majority of the firms look at the usage of LIFO. Coming to this weighted average cost method, it's simply I take the average of all these costs, 10 at 10, 20 at 20, 30 at 30. So overall the cost is 1400, and there are 60 items that are there. So the average cost of the item is somewhere around, let's say, 23. On an average, the cost of the item is somewhere around 23.33 bucks. Now what we say is, because 40 items are sold, the cost associated with the 40 items, 40 into 23.33, around 92, or whatever it is, 40 into 23.33, 20, so probably I can say 40 into 150 by 6, 140 by 6, so resulting in 6400 by 6, which is working out to 106, 1066 or something. So this 1066 is typically coming out, 5600. So with this 5600 by 6 working out to 933 something. So revenues are 1600. The cost of goods sold will show the 933, and the inventory will be more or less associated with the remaining 20 into 23.33, which is around again 467 or something. That is coming out as the inventory. Cost of goods sold is showing 933. So the cost is averaged out across the entire period, and depending on the number of units that are sold, the expense corresponding to that will be treated as a part of cost of goods sold, and the remaining is treated as a part of the ending inventory, right? So generally, when we see an inflationary kind of an environment, we see that whatever is the cost of goods sold that came in the whatever is the cost of goods sold that is typically coming up with the weighted average cost method lies between the cost of goods sold obtained through the LIFO method and the one that is obtained through the FIFO method. Now, one simple thing is with respect to the one important point that needs to be remembered with respect to the standards is LIFO is typically not allowed with respect to IFRS. IFRS does not recommend the usage of LIFO, whereas FIFO and weighted average and specific identification, they are allowed under both the methods, right? So this is one major mechanism associated with the inventory expenses or cost of goods sold expenses, the different mechanisms in which the cost of goods sold expense need to be recognized in the financial statements. A brief understanding of that particular aspect, which everyone needs to be comfortable with, right? Then the other major expense that requires a good amount of comfortability is how we treat depreciation expense, especially when long-term assets are procured. When I say long-term, any purchase that the company has made, let's say the machinery or plant, building, all these things which are purchased for the business perspective, they are going to give benefit for more than 1 year. So any of those kind of purchases the company has made which would be used for more than one financial year, they get treated as long-term assets or long-lived assets. They have a higher life. They have a long life. So even in those cases, to a large extent, we look at going ahead with some kind of a matching principle, because they are used for the purpose of business and they will generate the revenues for the business for more than one financial year. I don't want to treat their entire cost, the cost of the entire building, I don't want to treat it as a part of the first year's expense itself, because this building will be used over 20 years for the same business. So I would like to allocate the cost of the purchase of that particular asset over the useful life of that asset. Now, in different cases, there is a different name that is called. We call it depreciation. The allocation of the cost over the life, we call it as depreciation. In case we are looking at tangible fixed kind of assets, we call it as amortization, the same spreading of the expenses over the useful life, especially when I am dealing with intangible assets like patent, copyright, softwares. I treat them as intangible, and in some cases we use the word as depletion, especially when we are using natural resources. All these mean one and the same, the allocation of the cost over the life of the asset. And a very common way of allocation for majority of these items is a straight line basis itself, which means if I assume that 5 years is the life of a particular asset, and I have purchased that particular asset, let's say for 10,000 bucks, we simply say I'll allocate 2,000 bucks each year as the cost associated with that particular purchase. Though I have paid all 10,000 in the year 1 itself, but because of the matching principle, I would like to allocate this cost over the 5-year period, trying to match it with the revenues on a straight line basis, right? But when I am doing it on a straight line, there is an assumption that I am making that this asset will be used equally in all the years. The asset will generate the revenues with equal potential in all the years. But in reality, we observe that majority of the assets are more effective in the initial years. They generate heavily in the initial years and they contribute less in the later years. So even if I have to match it much more appropriate, it would be a more appropriate if I am doing some kind of accelerated kind of a depreciation. So that is where we talk about so depreciating high in the first few years instead of 2000. Probably I may say I will go with 4000 in the first year, 3000 in the second year, 2000 in the third year, 750 in the fourth, and 250 in the fifth. Some such kind of mechanism where I am accelerating. Initially, I am showcasing higher depreciation, which is more of allocation of the cost, and in the later periods, I am showing a lesser. This is more and more appropriate in some cases if I have to consider from a better matching perspective. So you could very clearly see that if I am using straight line, initial years the depreciation expense is much lesser. If the depreciation expense is much lesser, probably net income is much higher, which means there is an aggressive recognition of the net income here. Right, but in this case, initially depreciation expense is much higher, net income is much lower, so there is a conservative. But what we see in the later years, the depreciation expenses are much lower here. So which means in these periods, I see that the net income is going to be much higher compared to the straight line method. But one thing is the overall, over the entire life, if I am seeing even this will sum out to 10,000, even this will sum out to 10,000 only. Which means over the complete life of the asset, there is nothing much, right? Now, just to talk about how the straight line depreciation is computed, whatever is the cost of purchase, and I would estimate if there is any kind of a residual value for it. Means at the end of the usage of it, let's say I want to use it for 5 years. I am expecting that the life of it is 5 years. But at the end of 5 years, I can dispose it off for some price. That is what I am calling it as a residual value. At the end of its usage, if it can give me some kind of a value by selling it off, that is what I expect it as a residual value. I divide it by the useful life. So basically, if I have purchased something for 10,000 bucks, I am expecting that at the end of 5 years, I will dispose it off and I get 1,000 bucks. 5 years is the life of it. Then on a straight line basis, I will allocate 1,800 bucks as the depreciation expense for that period. But when I am using an accelerated method, I'll try to increase the number a little bit. Probably depending on the usage, I would try to speed up. Instead of showing 1,800 over all the years, I will show a slightly bigger numbers in the initial period, and it keeps going down and down over the later periods. But overall, the total will still be 9,000 only that is allocated. A special form of this accelerated method is the declining balance method. This is a slightly different way of allocating the depreciation. I'll use the declining balance. Sometimes we call it as 1.5 DDB, 1.5 declining balance method, or double declining balance method, or triple declining balance method, any of these. The most common one, let's say, being the declining balance. What this declining balance goes is some percentage of depreciation is applied over the book value every year. Some percentage of the depreciation is applied over the book value. Let's say in the same earlier example case, okay, 10,000 is the cost of the asset. Now, the most common one, let's say, is double declining. When I use double declining, yes, okay, there is a useful life of 5 years. Right, the asset has a useful life of 5 years. Forget about the residual value in this case. There is a useful life of 5 years, which means as per the straight line depreciation method, the depreciation is 20% every year. Now, what the double declining balance method takes is double of what a straight line balance goes with. So it takes 40%. So what it does in the first year, the depreciation is 40% of the book value, which is 4,000. Now, once the depreciation is 4,000, now the book value will become only 6,000 because 4,000 is already depreciated. Now, in the second year, the depreciation will become 40% of 6,000. So, 2,400 will be the depreciation. Now, the revised book value is 3,600 only. Now, in the third year, 40% of 3,600, which is 1,440. So by now, what we could see is 7,840 is still is already depreciated at the end of year 3. Now we'll go to year 4. Okay, once I remove 3,600 minus 1,440, the balance that is left is 2,160. Now in the fourth year, again a 40% of this is applicable. So it goes as 864 bucks is applied as a depreciation for the fourth year. So taking it to 8,704 has been depreciated till then. So this process continues until the residual value is reached. Right. So in the next year, whatever is left, it is 2,160 minus 864 is what is the book value that is present. So 1,296 is the book value. Now again I'll go with the 40% of this. Now, but only 296 need to be depreciated because 40% of this is taking it closer to 500 and something. But I don't need 500 because only 296 need to be depreciated because 1000 is the residual value. So these would be the depreciations that would be applicable if I'm going with a double declining balance method. Right. So in a simple way, I'll take it as 2 divided by the useful life and I multiply it with the cost minus the accumulated depreciation till now. So I'll take that and I typically apply a percentage on the top of it, which would give me the depreciation that needs to be computed for each of the periods. So it would be more and more higher depreciations in the initial periods, resulting in a lesser net income in the initial periods compared to a straight line balance method. Now, if the asset does not have a residual value, in this case, I have taken the asset is having 1000 as a residual value. But if the residual value does not occur, if there is no residual value, what could have very much happened is, in this case, let's say, okay, 512 would have been the depreciation, then some more, then some more. It never ends up because of this geometric nature. It can never end up to become zero. It does not become zero. It becomes only at an infinite point in time, which means the whole depreciation is not applied at all. So that's the reason in majority of the cases, especially when there is no residual value, we talk about the double declining balance method or any declining balance method getting converted to a straight line method after some time. After 3 or 4 years, we can very well convert the double declining balance method into a straight line method. The same logic applies even to the intangible assets also, but in majority of the time the intangible assets get depreciated or amortized. We use a word called amortization for intangibles, but they get amortized based on a straight line method only, though the accelerated methods can quite comfortably be used, but in general we try to apply a straight line method itself. But a few important points with respect to intangible assets: any intangible with indefinite life. So when I talk about indefinite life, generally we use goodwill. Goodwill is something which is not for a particular period of time. It can be there forever. That's the reason we don't amortize the goodwill. We keep it as it is. We don't decrease the value of it. But we will test it for impairment. Every year we will do an impairment test. We'll talk about them at a slightly later point. And in case we find it as impaired, we will reduce the value by that much amount. And at the same time, we'll show it as an expense in the income statement corresponding to that amount which it has lost its value. We'll try to understand these kind of specifics at a much later point in time. And on the same lines, a few important aspects, especially with respect to bad debt. See, we sell goods or services, and let's say these are being sold on a credit. So obviously, if these are sold on credit, an accounts receivable is getting created. And in some cases, we even have a warranty kind. Even if I have gone for a cash purchase or cash sales, there could be a warranty that could be there on the product. Now, so because of which what could happen, some portion of the money may not be collected even in the credit sales, or some portion of the goods might come back. So even that because of the warranty. So if I can reasonably estimate them, if I can reasonably estimate what proportion of the goods are going to come back, or if I can reasonably estimate what percentage of my credit sales will result in non-payment, I can very well book my bad debt expense as per the matching itself, because these are the goods that I have sold during this period. During this period, I can expect these many are to end up with bad debt. These many I can expect that I will get them back because of the warranty or malfunctioning. So if I can reasonably estimate them, these two can be recognized as expenses as per the matching principle itself in the period in which I have generated the revenue corresponding to them. So a better estimation based on either the historical experience or based on the competition and the industry, some basic some thorough estimates with respect to these two expenses. If they are done, even they can be treated as expenses going with the matching concept itself. Now, from a financial analysis perspective, again, just like a revenue recognition mechanism, we could see that there are so many estimates, so many assumptions that are going into the expense recognition. There is a lot of thing that is going towards the management discretion in terms of the expense recognition. So there could be a possibility for the manipulations also, because of all the above stuff, I could very clearly see that the company may play around with the expenses. Either it can be a very aggressive or it can be very conservative. If it is very aggressive, it shows much lesser expenses in the initial periods. If it is more and more conservative, it will show more expenses in the initial period. So we, as an analyst, comparison of these kind of as estimates, assumptions, one across time, which is over the past, or looking at the competitors, and if the company has changed any of these principles, what could be the reason behind the changing of these estimates and all, especially with respect to the bad debt estimate, or with respect to the warranty estimate, or for that matter wherever the estimates are typically being used. It's better that the firm try to look at these estimates with respect to time, with respect to competitors, see where the differences are significant, and try to understand if there is any specific reasoning regarding the change in the estimates, or probably do a thorough analysis in terms of whether the change in the estimates are because of process improvement, right, because of a process improvement, or is the change in the estimate purely as a part of the manipulation process. The analysts need to evaluate these things quite thoroughly, so that the overall recommendation that he is providing for the investors or lenders or creditors reflects the true performance of the company in all aspects, right? So this is what is very important for us to understand from the various expense recognition mechanisms in the financial statements. All right. In this session, I would like to look at how we would be handling the non-recurring and non-operating items in the income statement. What do we mean by non-recurring items? What do we mean by non-operating items? And how are they looked at in the income statement? So on a broader scale, if I have to look at these non-recurring and non-operating items, I can look at the discontinued operations. If the company has discontinued a few portions of the business, how would they be handled in the financial statement or in the income statement? Then we will talk about extraordinary items. What do we mean by extraordinary items, and how are they handled in the income statement? Then we would also see a category called unusual or infrequent, but not both. Unusual or infrequent, but not both kind of items. How do I represent them in the income statement? Then we'll see the changes in the accounting policies, right? Changes in the accounting policies or standards. How are they typically reflected? And finally, I would also see what are these we call as non-operating items, and how do we represent these non-operating items in the financial statements. So these are the different dimensions that we would focus in this session. So just getting started with the discontinued operations, one of the most important aspect in the non-recurring kind of items. So I would look at the discontinued operation. So whenever we are saying a discontinued, from the management perspective, they have planned, that a particular unit or the particular line of business or a particular geographic location, it would be shut down, or a particular product. So management has planned that it is going to exit out of this, but not yet done, not exited. There is a plan for exit. I mean, there is a roadmap. Okay, within another 1.5 years, we are going to exit. So there is a kind of a roadmap. There is a planned date, which is typically called as the measurement date. the day on which the planning phase started, and this is actually the deadline. And during this period, this entire period, from the day the plan started and from the to the actual date of disposal, we typically call as the phase out period, right? So if the company has created such kind of a plan but it is not yet disposed, or it is disposed completely during the current year, during the current financial year, there is a disposing of that, but during this period there is some income. During this year it has generated some income or some losses, and so even that is treated as a part of discontinued. But one thing is, in both these cases, whether there is a plan, whether a plan has been in place but full disposal has not yet occurred, or disposal has occurred in the current year, in both these cases we treat that particular operation as a discontinued operation, and we try to treat it separately from the rest of the firm, right? So that we can very comfortably assess that in the future this number will not be there because it's already a planned discontinuement. So in the future we don't suddenly see a surprise in the numbers saying, okay, up to this year when this particular plant was included, this was the revenues and net income, but in the next year it has fallen. So it should not be attributed to the non-performance of the company. It should be purely looked at it because this particular business is discontinued. Now the comparison should happen with this portion in the financial statement. So that's the reason, from all specific dimensions, the discontinued operations need to be treated separately only. So the way we represent them in the financial statements, so any kind of income, gain or a loss, whatever is coming in the discontinued operations, I will compute net of tax separately. The income, the expenses associated with this discontinued operations, I will compute separately, net of tax, and I will present it as a separate block. So which means this is a continued operations block where I have revenues, expenses, and finally computed the net income. One more block I would create at the bottom, which is the discontinued operations block. Again, here I will have a separate revenue, expenses, and the net income. So the net income which we would be using for all practical purposes is this particular net income, whereas here we will show it, this entire thing will be shown as the discontinued operations block separately after the net income. The net of tax would be considered and would be represented. And at the same time, because we have to present comparative financial statements, so even the last year's, I would restate it in this way only. Last year, I might not have discontinued this unit or operation, but because of the possibility to create a comparison, even for the last year's statement, I would restate only containing the continued operations and the discontinued operations being stated at the bottom. So that kind of restatement has to happen, right? And even for the past statement also, wherever we are providing the comparison, even there I will make the necessary changes so that comparison becomes more and more appropriate. So if there is any kind of estimated loss, right, on the measurement date, right, on the measurement date, which is the date on which the plan has come out, if I am estimating that some kind of a loss can come out because of that operations until during that phase out period, during the phase out period, if any kind of loss is estimated, that entire loss can be accrued. So the whole loss is spread out during the phase out period. The loss has to be accrued during right from the measurement date itself. And but in case there is an expectation of the gain, until the real phase out happens, do not consider the gain. If there is a loss, show the estimated loss as a part of this on the measurement date itself, not until the end of the actual date of phase out. Show the estimated loss in the income statement on the measurement date itself, but if there is an expectation of the gain from it, don't show any kind of a gain until the actual transaction is completed. So in simple essence, any discontinued operation, the whole income or loss from the discontinued operation is shown as a separate block after the net income. So from an analyst perspective, it's better that he does not consider this block, because this will not be existing after this period or at the max next period. Only this block should be used for forecasting, or this block only should be used for valuation purposes. So that makes the analysis more and more straightforward, right? So this is how a discontinued operation needs to be looked at. Then I will look at extraordinary items. Typically from the definition, when I say extraordinary items, something which is unusual in occurrence, it's not a regular thing. The definition is also pretty unusual, and it is even infrequent, both. And it is infrequent, it occurs only once in a while, it's not a periodic occurrence, and even the event is completely unusual, it's not routine. So especially when I look at the examples like uninsured losses from natural disasters. Generally, the companies, they insure all their losses, but if there is a big natural disaster has occurred, which is not planned one, right? Regular natural disasters again might be planned and might be insured, but some specific unusual disaster has occurred and the insurance for the same has not been taken, so the amount is also much higher. The loss is unusual, it's infrequent, probably that kind of loss occurs once in a while, once in lifetime. So these kind of losses, we categorize them as extraordinary. Sometimes we pay off the debt, early retirement of the debt. Sometimes this may not be a usual operation of the bank or of any company. It's not a routine operation of the company, and it's an infrequent. It did not happen in the company till date. So that kind of a transaction can be categorized as an extraordinary item. Now, whenever these things are treated as extraordinary, even these extraordinary items, again, we have a separate treatment in US GAAP versus IFRS. In case of US GAAP, I will treat them separately below the net income. Just like a discontinued operation, I will treat the extraordinary items separately net of tax, just like the way I have handled the discontinued operations. After the net income, net of tax after the income from the continuing operations. So this comes after this. So again, from an analyst perspective, he can completely ignore this block off. But from an IFRS perspective, there is nothing called separation. Both of them needs to be treated together itself. The operating results as well as the extraordinary items, both of them need to be treated in the income statement itself. So there is a change in the way they are presented in both. But Simple way, even if it is presented here, the analyst can very well take his own assumption in terms of removing them from the analysis. But sometimes what happens is some companies, they keep having this number every year due to some kind of risk taking nature that is associated with those companies. They may not insure some of the losses, or they have more and more losses possibilities of occurring. So for those kind of companies, probably some retaining them is much more appropriate rather than completely ignoring. So some kind of judicial way of treating them is required from the analyst perspective. But this is how the extraordinary items get reported and evaluated in the income statement. Then the next dimension that we will look at is something which is unusual or infrequent. It's not both. When it is both unusual as well as infrequent, then we treat it as an extraordinary. But if it is only one of the two, we have a slightly different way of handling it, right? So it is either unusual or infrequent, especially sale of asset. I sell off some assets, it's unusual, and at the same time it may be an infrequent exercise but may not be unusual. I don't know when I'm going to sell off, but I may sell off once the asset is becoming older and older. So it's an infrequent. So whatever the gain or loss that I get on the sale of asset, will treat it as infrequent item. Impairment, okay, it's an unusual. Some assets which lose their value, I would try to reduce their value. Probably on an annual basis I am doing their impairment test, but very rarely they undergo an impairment. So any kind of impairments or write-offs, any loan, a big loan that I have given, but I've sold something to a customer on a very big scale, but I'm not able to recover that. I don't know when I would be recovering, so I may want to write it off. So which is more infrequent but not unusual. So these kind of various elements which are either infrequent or unusual, I am keeping in the income statement itself. In the income from continuing operations itself, it would be there, which is reported before tax. So typically unusual or infrequent items are shown before tax, and on the top of that the tax is computed and the net income is typically arrived at. So they are going to impact the net income. The unusual or the infrequent items are going to impact the net income. So probably the analyst may think of keeping them rather than removing them from the analysis. Some kind of a percentage allocation or some kind of a pattern with respect to what would be the typical value associated with this unusual or infrequent items need to be understood, and the allocation be made accordingly. So that is how the unusual or the infrequent items get treated in the financial statement. Now, any accounting principles that are changed, right? A change to the accounting principles or standards or estimates, any changes that are typically coming up from the previous year to the current year. So if at all those kind of changes are occurring or some kind of errors coming up in the previous periods financial statements. So here there are three major things that I can look at. Accounting principles changing. So when I say accounting principle has changed, the company might have moved from one accounting principle to the other. Probably the depreciation. It might have changed from straight line depreciation method to accelerated depreciation method, right? So Now, when it has changed from one method to the other, what is typically expected is, apart from explaining the reason for a change, there is a retrospective application. Means the prior period, whatever is the past period that the company is showing for comparison purposes, even that period's financial statement also need to be restated based on the accelerated depreciation method, not just the current years. So it has to be applied retrospectively to the past year's financial statement also accordingly, and the whole financial statement need to be restated. So that becomes that enhances the comparability. Otherwise, some numbers unnecessarily go up or unnecessarily go down just because of a change in the accounting principle. So to promote comparability, it is very much expected that if there is any kind of such change in the accounting principles, it is mandatory for a company to restate the prior period's financial statement also based on the changed accounting principle. So that means that is what we call as retrospective application. But if at all there is a estimate change instead of principal change, if the company has initiated an estimate change, when I say estimate change, it could be as simple as a salvage value on an asset. Earlier they thought that the salvage value is 500 bucks, but now they are estimating that the salvage value is only 200 bucks. So if at all there is a change in the estimate regarding the salvage value, or probably if at all they are expecting a change in the useful life. Initially they thought that the asset is having a 10-year life, but now they are feeling that it is not beyond 5 years. In this kind, these are what we are calling as estimate changes, because of some kind of updated information that they have got. Their management came to a conclusion that keeping the estimate at the original value does not make any sense. They want to revise the estimate. So in this case, I don't need any retrospective application. It can simply be prospective application only. So whatever is left, whatever is the book value that is left, based on that, the new depreciation, the new depreciation or new value for the expense can be computed. But the past financial statements need not be restated again and again. So whenever there is an estimate change, I don't need to look back. But when there is an accounting principle change, yes, there has to be a restatement of the past. And in some cases, we also talk about a prior period adjustment, especially in the previous year's financial statements. If there is some kind of an error, if there is some kind of an omission in the last year's financial statement, or a wrong method being used for computation, any of these things happened in the previous financial year, I can make some kind of correction to the previous financial year and I can represent it. So if that is the kind of error that is there, then again the whole prior financial statement, the previous year's financial statement, that needs to be restated. Again, at retrospective application, they have to be completely restated, and the clear disclosure, what was the error and what is the typical effect on the net income. Last year, what was the net income when you ignored this, but now when you are replacing with this, what is the effect on the net income? So this part should be very clearly disclosed as a part of the footnotes. So these are some of the important things that come out, especially when some accounting standards change. But one thing in all these cases, one, the cash flow does not get affected. So that's one thing. That's a good thing for the analysts. The cash flows do not get affected. It's only the change in the values, the expenses, net income could change, and that's where We have to see whether all these changes are in real true, or is it because of some kind of manipulation that the management is really working out to. Because overall cash flows do not get impacted, but yes, some assessment with respect to the future net income, what is the kind of impact of this change on the future net income of the company, needs to be assessed properly by the analyst. And at the same time, if there are some errors and omissions in the previous, though the cash flow will not change at all, but it talks about the worthiness of the internal controls that are there in the company. How effective are the internal controls? Why are they not able to identify the errors? Why were there omissions? Why was the wrong calculation being used? So, is the review process for stating into the financial statements appropriate or not? So, that gives some kind of doubts regarding the effectiveness of the internal controls within the organization, right? Now, one important aspect that comes out is the operating component and the non-operating item. Operating item or the non-operating items in the financial statement. See, operating is primarily to do with the core business. And for a manufacturing firm, right, for a manufacturing firm, any activity that is relating to the production of the good and the service, that is mostly the operating part. So expenses wise, all the operating expenses are shown separately, and the non-operating, especially when I say non-operating, for a manufacturing firm, probably investment is completely non-operating. It tries to invest in some bonds, it tries to invest in some shares, so it tries to invest in some mutual funds. So this investment activity is completely a non-operating kind of an activity. Now, in this, it could receive probably some kind of dividend, it could receive in those companies which it has invested, or it could receive some form of interest. So, these kind of receipts of income and these receipts of income, they are treated as a part of non-operating income itself. This is an income that is not coming from a regular course of business of the company. This is something because the company had some excess cash, it is simply doing the investment and it has got some kind of income on those investments. Similarly, there could be a few financing activities. It has raised the capital in the form of debt, so it is paying towards the debt. So probably the interest that it is paying for the debt investors, it's a part of the financing activity. It has nothing to do with the operations. Similarly, the dividend that is paying to the equity investors is again for the capital that it has raised in the form of equity. So these are independent of the operations of the firm. So we talk about all these components as a part of non-operating components in the financial statement. So whether they are income or expenses, they need to be shown separately from the operating component. These two should not be clubbed in terms of presentation. That's one more thing that we need to be careful of when we are looking at the different elements and accounts that are typically coming into a income statement. So that's how a special focus need to be kept on the non-recurring kind of items and non-operating kind of items, because they in some cases form a significant portion, but they have to be very carefully analyzed for doing an appropriate assessment of the financial health and even the valuation of the company, right? In this session, I'm going to look at on an overall basis, just by looking at the income statement, what is the typical analysis that is performed, right? So, the major things which are expected to be covered is one, an understanding of the common size analysis. When we look at the income statement, one thing which we can quickly do is the common size analysis and a few exclusive income statement ratios. And typically I look at them more towards profitability, because the net outcome that comes out of the income statement is the net income, which is the profitability. So some kind of a profitability assessments can be done just by looking at these ratios. So quickly, I mean, though in detail we would be doing slightly at a later point, but just to understand these two important mechanisms of analysis on an income statement, if I have to start off with common size, all we simply do is, this is typically called as a vertical common size, right? When I say this vertical common size, let's say I'm taking this example. So this is my income statement. This was something that is present in the annual reports of the company, and let's say we have summarized it this way. Now when I'm saying common size income statement, all we do is we try to establish each of these categories, each of these values as a proportion of the sales or revenues itself. So I'll take the sales, divided it by the sales. So that gives me 100%. Probably if I'm putting it in a percentage form, 100%, and probably when I'm dragging it across, I could see that yes, net income is 26.89%, or if I want, I could very well include the gross profit, right? I could include the gross profit here, simply saying the sales minus the cost of goods sold. So this is my gross profit, and the same here also gets computed as gross profit is 50.25%, right? And if I'm looking at the net income, probably I can here change the formula a little bit. Gross profit minus of all these, or operating income is where I had a problem. The gross profit minus the total expenses here, I should consider it as only these three. Yeah, so this is what is going as a part of my net income, 26.89, operating income is 34.26, gross profit is 50.29. Now if I am establishing all these numbers of the income statement as a percentage of the sales or the revenue, I call it as the vertical common size. So for each year, that particular year's sales or revenue is what we fix it as 100, and all other numbers we divide by the sales or revenue for that particular year. That is called as a vertical common size income statement. But when I look at the horizontal, so probably if I have year 1, year 2, year 3, I have sales, cost of goods sold, gross profit, etc. So A, B, C, D, E, F, G, H, I. Now, the first year, the initial year is fixed at 100 for all of them. The initial years is fixed at 100 for all of them, and B divided by A, E divided by D, and H divided by G. The same logic here, C divided by A. F divided by D and I divided by G. This is a horizontal common size. So it is more like a trend. Initially, in the first year, when all these numbers were 100, I'm looking at now to what extent they have grown compared to the base year, by how much they have increased year over year until date. Probably it might so happen that the sales have gone up by 20%, but the gross profit has gone up by 50%, or any such kind of things could be there. So this is a horizontal common size, but the most common size analysis that is typically done is vertical. Each year's financial statement, each year's every category is divided by the sales or revenue of that particular category, which means the size effect is eliminated. Even if it is even if the sales are very high, I'm looking at the cost of goods sold in terms of percentage. I'm looking at the gross profit in terms of percentage. Otherwise, if I'm talking of a small company versus a larger company, obviously the sales of this will be much higher. The cost of goods sold also will be much higher compared to this. And it might very much be possible that net income in the dollar terms will be much higher for this compared to this. But if I start converting it into percentages, the size does not matter, because the revenues for this is also 100, the revenues for this is also 100. That gives us a scope to compare different companies which differ in size or even across time. The historical performance can quite comfortably be considered. So it becomes much easier to do a time series analysis, which is the comparison across time, and also a cross sectional analysis, which is more of a comparison across different companies as well. So that's the reason any income statement that is looked at, initially we perform a vertical common sizing analysis on that. And it can help me to understand the overall strategy of the firm. Where is it spending more? Is it spending more and more on cost of goods sold? Is it spending more and more on selling and marketing expenses? Or is it spending more and more on is the cost more and more on depreciation, which means did it spend more and more on fixed assets in the past? The whole strategy of the firm is going to come up, especially if I'm comparing two firms. The what are the key differences in terms of the operating expenses of both these firms can quite comfortably be understood by getting into this kind of common sizing analysis, right? And it can help us in doing a better prediction of the numbers or forecasting the financial statements quite comfortably for the future as well. So that's one of the prime reasons a vertical common size analysis becomes more and more helpful for us. And it even makes a lot of sense exhibiting or establishing every item of the income statement as a proportion of the revenue, except for tax. And generally for tax we don't establish it as a percentage of the revenue, but generally tax we try to establish it as a percentage of the profit before tax, and we try to call this number typically as the effective tax rate. That particular tax as a proportion of the pre-tax income. So that's one kind of an analysis that is performed on the income statement. Then the ratios, okay, some of these ratios are named purely based on the two different values of the income statement. And pure income statement ratios, majority of them deal with the margins. The margin based ratios more and more a factor of the profitability, determinants of the profitability of the firm. So the two major ratios, the gross profit margin, I look at it as gross profit divided by revenue or the sales. Then I have the net profit margin, which is again the net income divided by the revenue or the sales. Now in isolation, this ratio may not have major significance, but if I compare it over time, how this gross profit of this firm has been changing year over year, or if I compare it with the industry standard or if the competitors, I could see how this company is performing compared to the competition, or where is it placed with respect to the industry. So if the gross profit margin has gone up, I could very clearly assess whether it is because of the revenue going up or it is because of the expenses going down. Such kind of clear-cut understanding and evaluation can be done by computing the ratios on a broader scale. So I could clearly see once I look at the ratios and do the comparisons, I could very well assess the strengths of the company from the performances, and I could also assess the areas of improvement on the same. And probably a few more ratios on the same lines. I could talk about operating income divided by the revenues, giving me the operating profit margin, or I could talk about the profit before tax divided by the revenue, giving me pre-tax kind of a margin. All these kinds of different margin based ratios can very well be obtained from the income statement. They could quite comfortably be used for comparing the historical performances or the performances with respect to the competitors. So every income statement we can do such kind of analysis and try to derive some strengths and weaknesses of the company which we are analyzing. All right. In this session, I'm going to look at one of the most important tools that is used by analysts, especially from the statement of comprehensive income or from the income statement, profit and loss statement, for typically assessing the performance of the firm, which is the earnings per share. So, what I would like to look at in this session is one, simple versus complex capital structure. Right? If the capital structure is what do we mean by, first of all, simple? What do we mean by complex? And how does the earnings per share computation differ in these aspects? And even in the earnings per share computation, I would look at the basic EPS as well as diluted. Diluted is something, especially when there is a complex capital structure. So I would like to look at how do I typically compute the diluted EPS, especially if the company is having some convertible preference stock, right? If it has issued some convertible preference stock, or if it has issued some convertible bonds or debt, right? If there is some convertible bond or debt that is outstanding, or if there are some kind of option like features, let's say stock options or warrants, right? Any of these kind of stuff. If the company has any of things, how do I typically compute the EPS, which we call as diluted EPS? And in what cases the changes that can come into EPS because of some accounting stuff, if the EPS changes and all, how does the typical reporting focus on? So these are some of the various aspects that I am going to bring out in this session. So just to get started, it's a very whenever I'm using the word EPS or earnings per share, we look at it as the most powerful profitability measure per each share, right? It's a profitability measure per each share. What is the net income that the company has generated? probably a mandatory year to be reported stuff for public firms. Of course, for private, there is not too much of a necessity to report the same. And whenever we are talking of EPS, the share per share is primarily from the perspective of common equity. We don't include the preference shares and all as a part of the EPS computation. Now, as I said, first of all, what is important for me when I'm looking at EPS is the current capital structure of the company. Is it simple or is it more complex? How do I differentiate simple and complex? When I'm having no dilutive securities, we say it is simple, which means there are no options. This company did not issue any kind of stock options or warrants, or any kind of convertibles, convertible preference stock and all. If it does not have any of these and it has just a plain stock, common equity or preference shares, or if it is having a non-convertible debt, then we typically call it as a simple structure. Whereas if all these things are present or any one or more of these things are present, then we treat the capital structure to be complex. Now, any company which is having any one of these elements, which is having a complex capital structure, the EPS which it has to report in its financial statements, it has to report both the basic EPS as well as the diluted EPS. Now, what do I mean by these two? Whenever I am talking of basic, it does not bother about the dilutives. And the diluted or dilutable securities, they are not typically included as a part of the basic EPS computation. So, as the word itself is saying, the net income, right? E is earnings, P is share, per share. So, earnings I take it as net income, but because I should not include the preference shares in it, I'll subtract the preference dividend from it, divided by the number of shares. This number of shares, instead of directly taking as number of shares, I'll take it as weighted average, because what could very much happen is these number of shares need not be constant throughout the year. It might have increased by the issue of new shares or decreased because of buyback of the share. So what we typically take in the denominator always is the weighted average of number of shares that are outstanding. So the weightage is typically based on any new issues happened or any buybacks happened. So that results in the computation of the basic EPS. Whereas when I am looking at from a diluted perspective, see all these things, convertibles. If it is a convertible preference stock, there is an option where these things can be converted into shares. Warrant again is an option to convert it into a share. Stock options, they create additional shares. Now what we typically are saying in case of diluted EPS is compute the EPS under the assumption that all these things are converted into shares. Assume that all these numbers are converted into shares and compute the weighted average number of shares accordingly. Now, if all these are computed into shares, again, some more differences may come with respect to the net income also. We'll try to see them, because a convertible bond, if it is converted into a share, the interest need not be paid. As long as it is a bond, the interest is typically paid on it. But once it converts into a share, the interest need not be paid. Means in the net income, I will be adjusting with the interest that is typically paid. So at the end, we'll look at the detailed calculations now, but simple logic is any of this firm which is having a complex capital structure, it has to report both the basic EPS as well as the diluted. Diluted is the new computation of the EPS under the assumption that all these dilutables, especially the options, the warrants, the convertible debt, convertible preferred stock, all these things are typically converted into shares of the company. The EPS, which is the revised EPS, is computed, and that is what we are calling as the diluted EPS. Right? So once we take up a few numericals, things become more and more easier for us. So let's try to understand some of these things. Now, first important thing is computation of the weighted average number of shares. Right? The denominator, let's try to compute. If everything is fine, no new shares are issued during the year, right? And no buybacks happen during the year, then computation of the weighted average of number of shares outstanding is a straightforward. It's just the number. But if some of these things have happened, that is where the differences in the computation come out. So let me take a small example. Right, so I am more interested in weighted average number of shares outstanding. Let me try to take a simple example for that. So let's say a company is having, right, let's say the company is having some 10,000 or 1,000 new share, 1,000 existing shares as on 1st Jan. Right, I'll talk of existing shares as on 1st Jan, let's say 1,000. New shares issued on 1st April. Let's say 200 new shares are issued. Now, in this case, if I have to compute the weighted average, a straightforward case, weighted average number of shares, all I will take is the 1,000 shares. 1,000 shares were there for how many months? 1,000 shares were there for 3 months or probably 0.25 years, plus 1,200 shares were there for the remaining 0.75 years. So for this period, if I really wanted the weighted average number of shares to compute the EPS, I would have taken 1,150. I can't take 1,000, I can't take 1,200. I'll take the weighted average number of shares to compute the EPS, whether it is basic or diluted. I'll take this as the weighted average number of shares. But the same example, let's say the new shares issued on 1st Jan, otherwise let me take one more case. Existing shares as on 1st Jan is 1,000. Right, the new shares issued on 1st April, let's say, is 200. Then 20% stock dividend. 20% stock dividend on 1st July. That is something that has happened. And after that, let's say shares retired, or probably I can say buyback shares. Buyback shares on 1st September. How many? Let's say there are 300 shares that are bought back. Now let's say this is what has happened. In this case, if I had to find out the weighted average number of shares, now this is where a slight understanding has to come out. See, a stock dividend. So one thing that I have to look at is whether company has given a stock dividend or stock split, one of these two, if something of these two have happened, then okay, the number of shares are growing in both the cases, but the percentage of ownership is typically not changing. Right? In both these cases, the percentage of the ownership is not changing. So I should really not bother about the weighted average, because weighted average is more from a dimension of the percentage itself. So I should not be much bothered about the way the inclusion of the stock dividend, only except where I have to make it neutral across. Now that the simple way for me to work out, especially when there are stock dividends or stock splits that have happened during the year, then for whatever the period I am doing the weighted average. So this is the period, let's say, for which I am doing the weighted average, and the stock split has occurred here. Stock split or stock dividend has occurred here. Now, whatever are the share related transactions that have happened during this period, adjust them with the stock split or stock dividend. And whatever are the events that have happened after that, do not adjust. So that's the first step. And after that, you simply go ahead with the weighted average computation, which means here if I have to do the adjustments, okay, there is a 20% stock split here. So which means 20% new shares, 20% extra shares would be coming, which means the same would become 1200, and even this would be incremented, because anything before that I'm going to increment it. So I'm taking 240 here, whereas this I will not increment because this is something that has happened after the split itself. Now if I have to compute the weighted average, it's as good as saying okay, 1200 shares are there for 3 months, right? 1200 shares are there for 3 months. I can very well write 3. We'll divide the whole thing by 12. So either I can write 3 by 12 plus 240 shares are there for 1st April to first, sorry, it's not 200. Either I can write it as, okay, 1200 shares are there for the whole year, right? 1200 shares are there for the either of the ways. 1200 shares are there for the entire year, okay, 12 by 12. Whereas the 240 new shares are there only for 9 months, because they are issued on 1st April, and I have to take out 300 shares, right? And this 300 shares, because they have bought back on 1st September, I have to take the weightage of the remaining 4 months. So overall resulting in a weighted average number of shares of 1280. This is what would go as a part of computation of EPS. So whatever is the stock dividend or stock split, even if I had said here the stock split of 6:5, 6 new shares, 6 shares per every 5 shares. So if I am saying 6 per 5 kind of a stock split also, it means exactly the same, and the weighted average computation would typically contain 1280 as the weighted average itself. So this is one important thing. So whenever there is a stock split or a stock dividend, so all those shares that are outstanding before this period, all the shares that are outstanding before this particular period up to the beginning, you make the adjustment with the split or the dividend. But after that period, till the end of the period, any of the stock related changes that have come, we will not make the adjustment, we'll take it as it is itself. So this has to be really considered. And just for a quick workout, either the days wise I can take the actual number of days to do the adjustment, or we can do an approximation to the closest month and do the adjustment. 9 months out of 12, or exactly if I have to go with, then probably 261 days out of 365, but approximated is probably 271 days out of 365, or approximated is 9 by 12. So such kind of approximations can very well be used, but in reality it goes with actual number of days itself, right? So this is what is the weighted average number, and once I have the weighted average number, I just need to subtract the preference dividend from the net income and divide it by the weighted average outstanding number of shares, and that will give me the basic EPS. Right now, if I have to go with the diluted EPS, this is where one single assessment comes into picture. One small assessment I have to do. First of all, every of these potential dilutables, are they really dilutive or anti-dilutive? For each, okay, if there is a preference stock, I have to see whether that preference stock is dilutive or anti-dilutive. If there are options given, I have to really check whether these options are dilutive or anti-dilutive. What does that mean? Any of those potential dilutables, if they are converted to equity, if they are all converted into equity, and after conversion I see that the EPS is dropping, right? After conversion, if I see that the EPS is dropping, then I call those kind of securities as dilutive securities. But if the EPS is increasing after doing their conversion, then I call them as anti-dilutive securities. Only when it is a dilutive security, I should look at including that into the weighted average computation. But if it is an anti-dilutive security, I'll not include it as a part of the computation of weighted average number of shares. So in general, okay, we have seen that the basic EPS formula, just to revise it, net income minus the preference dividend divided by weighted average number of shares. Now, if there is a convertible preference stock, if there is a convertible bond, if there is a stock option, I have to check whether each one of them are dilutive or anti-dilutive. If they are dilutive, I have to make the adjustment to this formula. Now, if I am looking at convertible preference stock and let's say it is dilutive, means what if this is converted into equity? If this is converted into equity, obviously I don't need to pay a preference dividend on this. So whatever is the preference dividend that I am paying, especially on this convertible preference stock, I'll add it back because that is no more an expense for me because it is converted into equity. Similarly, if there is a convertible bond and let's say the bond is converted into equity and let's say it's an dilutive kind of a security, which means because it is converted into equity, the interest on the bond need not be subtracted to arrive at net income, which means the net income will be much more higher, which would be to the extent of interest into 1 minus t, because the interest is tax deductible. Now it is becoming equity. So whatever was the gain that has come, whatever was the benefit that has come earlier in the form of tax saving, now is no more applicable, which means the net benefit is only I into 1 minus t. So even that part I would be adding it back. And regarding the weighted average number of shares, Now we would be seeing, okay, one convertible preferred stock, how many equity shares it is getting converted into, add it up. One for each convertible bond, how many equity shares are getting created. I'll try to go add that stuff. And for each option, the new shares that are getting created, what are the new shares, how many new shares are getting created if all these options are exercised. If all the warranties are exercised, what are the new shares that are getting created? All these things we would typically find out to the computation of the weighted average number of shares, and finally we would end up with that calculation called the diluted EPS. We'll try to do one numerical calculation which will simplify our overall understanding. But any of these things added to the dilutive EPS, they should be dilutive securities. I have to evaluate them separately, whether they are dilutive or anti-dilutive. So the denominator will be adjusted for equivalent number of convertible preference stock which get converted into equity, or convertible bonds, to how many equity shares they are all getting converted into. All these things I compute separately and I add it to this particular list, right? And especially if this dilutive security was created only in this year, just 3 months back, then even for the computation, I'll not include the whole year, I'll take only the weighted average, which is 0.25 weightage to the same. So that part remains the same, but the major thing for me is computation of these two. But in case of stocks and warrants, there is, or stock options and warrants, there is a slight different method, which we call as the treasury stock method. See, generally, what is happening, let's say the company has issued 100 stock options, and now let's say these options are exercised. If these options are exercised, there is a money that is getting inflow. Means exercise is for a fixed price which is decided at the beginning of the issue of the option. The employee is able to purchase the share of the company. So because he is purchasing the shares, there is a money inflow that is coming. Now what is expected is, what is this treasury stock method is, the company will use this fund that has typically come because of the exercise of the stock options, use this money to buy back virtually buy back the existing shares in the market at the market price. So which means the net new shares will be primarily based on how many new shares got created because of the exercise minus how many shares got bought back using the fund that has typically come in. That net is the result which would be added up to the weighted average, especially when dealing with stock options and warrants, right? And typically also we would see that the exercise typically happens if the exercise price is less than the average market price during the year. Otherwise it would not be exercised, and what we see is the options go worthless altogether. So we can take one simple numerical, try to understand the overall the impact that is going to be created, right? So let me take one numerical which could include all these things for the computation of EPS. Okay, let me take a few things. Net income of a company, right? Net income of a company, let me take it as 200,000. Then I'll say preference dividend is 10,000. right? It has declared a preference dividend of 10,000, and the number of shares is, let's say, 100,000. So let's say this is the case. Now here I can compute the basic EPS without any kind of a complication. I'll take it as net income minus the preference dividend. I divide it by, let's say this is the weighted average of the number of shares itself. I can very well say that the basic EPS is somewhere around 1.9. Now I am talking about let's say a preference stock or convertible. The company is having convertible preference stock. What is this convertible preference stock that the company is having? Okay, let me talk about number of units, number of shares, number of convertible shares that are there. Let's say 100 convertible shares are there. The dividend, 8% dividend, and par value, let's say, is around 100 or 1000 is the par value. So when I say 1000 is the par value, okay, what is the preference dividend that is coming out here? The preference dividend that is coming out here is 8% of 1000, that is per share, and there are 100 such shares. So there is 8000 that is coming out in the form of preference dividend. Overall there was a 10,000 preference dividend, which means some of them, the 2000 worth is not on the convertible preference stock but on the regular preference stock, non-convertible preference stock the company has given. But this 8000 is on the convertible preference stock. So if at all this gets converted into equity, this 8000 need not be paid, right? If it is getting converted into equity, the 8000 need not be paid. So what I can very well check, now I have to understand the conversion ratio. The conversion ratio for me is, let's say one single share is getting converted into 25 shares of equity, right? Let's say we are talking of one single convertible preference stock which is having a face value of 1000, let's say is getting converted into 25 shares of equity. So how many new shares are getting, so because of that, number of new shares that are coming up is 25 times 100, which is 2500 new shares are coming up. So the new EPS which I have to look at now is whatever was the net income earlier minus the preference dividend that was there plus the preference dividend which is coming out because of this mechanism, and I am dividing the same with whatever was the weighted average number of shares that were there earlier plus the new shares that have come out because of this conversion process. So resulting in a new EPS of 1.93. The new EPS actually got increased, which means this is what I call as an anti-dilutive security. But on the other side, let's say if the conversion ratio is 50, which means one preference share is getting converted into 50 common shares. If that is the case, the new shares that got created is 5000, and what I see is the new EPS is 1.88, which is lesser than the basic. Then I'll call this particular security is a dilutive security, and I use this into the computation of the EPS. Right, so the diluted EPS now is 1.88, but when the conversion ratio was just 25, Because the new EPS has actually gone up under the assumption that this is converted into equity. When I have tried computing the new EPS, I am seeing that the EPS has actually gone up. Then I don't call it as a dilutive, I'll call it as anti-dilutive security, and I will not include it as a part of my diluted EPS computation, which means in that case my diluted EPS also would have been the same as the basic EPS only. So that is what we do as a part of the convertible preference stock calculation. Similarly, let's say I have to talk about the convertible debt. Now I need to know the number of bonds that are there. Let's say there are 500 bonds the company has issued, right? Then again, the par value of the bond is, let me assume it as 1000, and the coupon on the bond, let's say, is around 7%, and again the coupon, then I can talk of so whatever is the coupon payment, right? I can look at what is the amount of coupon that is getting paid every time. I can look at it as 100,000 multiplied by 7% multiplied by 500. So this much of coupon was getting paid in every period, but because of that much of a payment, there is some kind of a benefit the company was getting. So we will try to adjust that. Now what we are saying is the conversion ratio here. Here I can take the conversion ratio. Let's say one bond is converted into, again, 50 shares. Right? When I am saying one bond is converted into a 50 shares, then I can say if at all the conversion is successful, the number of new shares that are getting created is 50 times 500, which is 25,000 is the new shares that are getting created. And assuming that it is converted, I'll find out the new EPS. Now individually I'll find the new EPS. So because I have to check whether it is dilutive or not. So here what will I do? 20,000 minus 10,000. Up to here that's not a problem. Now I am checking out this. So if at all this is converted into equity, I don't need to pay this coupon. But of course, as I said, in this coupon, only the non-taxable portion of it I would be looking at, because I would be losing the tax benefit once I convert the debt into equity. So let me assume that the tax rate is 30%. Right? If I am assuming that the tax rate is 30%, the numerator is getting adjusted to that, and the denominator is coming out with number of existing shares plus the number of new shares that are getting created, resulting in the new EPS is only 1.71, which means even this is a dilutive security. So this is a dilutive, so I'll include them in the computation of my overall diluted EPS. Even if the conversion ratio is 40, still it is a dilutive. Even if the conversion ratio is 30, still it's a dilutive kind of a security only. So, okay, let me assume it as 30, the conversion ratio, which means it's still a dilutive security. Even this is a dilutive security. So, I'll include both of them as a part of my computation of the diluted EPS for the company. Now, I could also see the stock options. Okay, the number of stock options the company might have created, let's say around 500 stock options are there, right? Around 500 stock options are there, and the share price, I mean conversion price or the exercise price, the price at which a share can be purchased, let's say it's around 25 bucks, but the average market price during this year, average market price of the share, let me take it as 30 bucks. So if that's the case, what I could typically see, the cash inflow, if at all the options are exercised. So 25 bucks multiplied by 500. The cash inflow that is coming out is 12,500. Number of shares bought back virtually using the treasury stock method. Number of shares that are bought back goes as this cash inflow divided by the average market price per share. So 416 shares are bought back, and number of new shares that are coming up into the computation is just 500 minus 416. So even this is positive, so even this is an diluted kind of a security. But wherever I find this price more than this price, then it becomes an anti-dilutive kind of a security. In that case, I'll not include it into the computation of diluted EPS. Now that I know that these are the three things that are there, overall diluted EPS is coming out as, I can start right from here to compute the diluted EPS. The net income numerator is net income minus the preference dividend plus whatever is the preference dividend on the convertible scenario plus 35,000 into 1 minus T for the convertible bond, and finally, and for the last one there is nothing because no payment can be stopped or anything. So the numerator, the adjusted net income is that particular number, and in the denominator I can actually start looking at, initially there were these many shares, but slowly we had 5,000 new shares because of the convertible preference stock. We had 15,000 new shares because of the convertible bond, and around 83 new shares coming up because of the stock options. So overall resulting in the diluted EPS to be somewhere around 1.85. So what we did in this process is entirely starting off with each of the potentially dilutable kind of a security, trying to find out whether it is resulting individually, it is resulting in an increase in the EPS or a decrease in the EPS, and only if it is resulting in a decrease in the EPS it would be included as a part of the computation of diluted EPS, otherwise it would not be included in the computation. So each potentially dilutable kind of a security, this is one potentially dilutable, this is one potentially dilutable, this is one. So each potentially dilutable kind of a security we have evaluated separately and checked out whether it has resulted in a decrease in the EPS or increase in the EPS, which is it really dilutive or anti-dilutive? And only when they are all dilutive, when each one is dilutive, all those dilutive ones we have included into the computation of the final diluted EPS. So from a reporting perspective, the company has to report both the basic EPS, which is this number, as well as the diluted EPS, which is going to be this number. As an analyst, this number forms an important thing to be used because it talks about what if all those convertibles are typically converted into the common stock itself, right? So this is the basic stuff that needs to be comfortable with as far as the earnings per share is concerned, how we compute the basic EPS and how we compute the diluted EPS. All right. Now I'll spend a few minutes trying to explain the concept of the comprehensive income. Earlier we have said that as a part of IFRS or the reporting frameworks, the company has to present a statement of comprehensive income. And we said that the statement of comprehensive income contains two parts. One is an income statement, which is the profit and loss statement, and the other is other comprehensive income, right? So the income statement, we have clearly we have seen that the structure of it starts right from the revenues and ends up with the net income. And as a part of the relationship also, we know whatever the net income that comes out in this particular year, I subtract whatever the company is paying dividend in this particular year. This is going as an addition. Whatever is the difference that is coming out, this is going as an addition to the cumulative retained earnings that were there at the beginning of the period. So what we are able to see here is whatever the change in the net income that is coming up, it is impacting the difference here, and this difference is going and impacting the retained earnings on the balance sheet, which means the balance sheet is getting impacted because of the change in the net income. Now, this portion that is getting updated to the balance sheet, this portion of the operations, the net income that is changing and which is getting updated to the retained earnings and thus contributing to the balance sheet. So it is affecting the once the retained earnings is getting affected, retained earnings is a part of shareholders equity, and even that is getting impacted, right? But there are various other things that go and impact the shareholders equity without passing through the income statement. They are not treated as a part of the income statement. Retained earnings is one portion which is treated in the income, which is coming from the income statement and which is updating the shareholders equity. But what is observed is there are various other things that are typically updating the shareholders equity, bypassing the income statement. Now that is what all those all those things go as a part of other comprehensive income, which means, see, there are a set of things that update the shareholders equity in the balance sheet. Shareholders equity section of the balance sheet, there are a few set of entries that update it. So any income statement related entries, they update what is called as the retained earnings portion, and that retained earnings portion is updating the shareholders equity. But there are various other pieces, other comprehensive income areas which do not go through the retained earnings. So they are captured as a part of other comprehensive income, which is again a part of this statement of comprehensive income, which go and update the shareholders equity. So these things we need to understand what are all those things that go as a part of the other comprehensive income, because that is resulting in an overall change in the shareholders equity situation. So the comprehensive income, which is actually a combination of these two, the statement of comprehensive income is a combination of these two. It talks about all changes that are coming into the shareholders equity except the transactions that happen directly with the shareholders, like new shares or buyback of the shares or the dividends. So except for those stuff, they are all directly impacting the shareholders equity. So I'm looking at the comprehensive income, except for the contributions and distributions, all other things that are impacting the shareholders equity are captured as a part of comprehensive income. Out of it, income statement captures the retained earnings portion, whereas all the remaining things are captured as a part of this other comprehensive income. Now, what are all those small things that are going as a part of that other comprehensive income which don't go into the income statement, or foreign currency translations? We'll look at each of these words at a later point when we are discussing the other topics. The gains or losses that are coming exclusively because of a change in the foreign currency value on the date of purchase versus on the date of payment. The change, profit or loss that is coming as a change in the foreign exchange rate is what is getting captured as a part of the other comprehensive income. We are not treating it as a part of the main income statement. Any kind of unrealized gains or losses coming from cash flow based hedging derivatives, we'll talk about these later. They are not directly captured in the income statement. Similarly, any kind of unrealized gains or losses that are coming from available for sale kind of securities. When I say available for sale, I'm not holding them for a trading period. I'll not dispose them within a next couple of weeks or months, and at the same time I'll not hold them for maturity. So those kind, I mean, I may sell them off slightly at a later point in time. Those kind of securities, whatever is the unrealized gain or loss, I have to treat it under the other comprehensive income itself. And nowadays, especially when the IFRS is more and more talking about fair value of assets, not the historic value. Now what happens? The assets get revalued every year. So that could result in an increase in the value of the asset. That increase in the value of the asset we directly don't take as a gain in the income statement. Rather we'll take it as a gain as a part of the other comprehensive income only. Those kind of gains or losses that are coming up, especially the gain, those kind of gains that are coming up because of the revaluation of the asset as a result of the representing it as a fair value, even those kind of gains that are coming up, unrealized gains that are coming up, even they would be treated as a part of the other comprehensive income only. So there are quite a few elements that are not directly going into the income statement, but they are impacting the statement of but they are impacting the shareholders' equity on the balance sheet. So all those elements which are impacting the shareholders' equity but not passing through the income statement, they are captured through the other comprehensive income. And uh, the income statement plus other comprehensive income put together is what is the statement of comprehensive income. So from an analyst standpoint, the analysis of the other comprehensive income needs to be very much elaborate, because these are the elements that are typically not passing through the income statement but are getting into the balance sheet. So the performance of the company is getting affected even with these numbers. So that's where an additional focus for the analyst should typically come from. All right.